we've been talking about this simple concept, actually, but an incredibly powerful concept of higher held offers, or sorry, higher held bids and lower held offers. And at its core, it's an incredibly valuable element. Not you'd have imagined that that was the case if you were in the London session. But one person appreciated it, so we'll hopefully get a few more appreciations on how valuable this is this afternoon. So we said we'd bring it back for you guys to take a look at, and that's exactly what we're doing. So this is what the storyline is all about. This is from the London session. And it has elements in profile, but it's way more than profile. It's actually just normal trading. It's what every floor trader would understand. It's not a profile concept as such, and it's not a Wyckoff concept as such, and it's certainly not an ICT concept as such. It's a normal trading concept that simply people understand to be true based on a very simple concept called supply and demand. It's also an element called the skewness of a marketplace as well. And obviously when we start talking about the skewness of a marketplace, we start understanding that that could be related to, for example, the B shape and the P shape that we know very well indeed from a profile perspective. It's also to do with the idea of fat tails. The concept of kurtosis, for example, is very obvious in this type of idea where we get a fat tail somewhere, which means that we're going to get an excess somewhere else, allowing us to recognize that the movement to one side versus the movement to another is certainly fat tailing this idea, and that gives us more of an idea about what direction price should be moving from and to. As a commercial operator, it's also one of the most important things that I mentioned when I first stepped foot in this room. And I said to Kim at the time, I says, there's no way we would ever sell a top edge unless we know that we've got sellers below us. And there's no way we would buy a bottom edge unless I know I've got buyers above us. And the first time you ask that question in any retail room, it seems as if 99% of people always get it wrong. If I said to you, if I'm a buyer, what do I need to have at higher prices? And everybody says a seller, and you're like, come on, guys. If I'm a buyer at lower prices, what do I need to have at higher prices? I need to have what at higher prices if I'm a buyer? I'll give you a clue. The answer is definitely not sellers. And how many people get that wrong, Kim? Every webinar we used to do in the olden days, 99% of people would say, oh, we need sellers at higher prices. And you're like, what? Why would you? I give up. So the idea is, of course, that if I'm a buyer, I need to see buyers at higher prices, because if I want to get rid of my position, I need them. I need them there so that I can sell my stuff to them at higher prices. If we haven't got any buyers at higher prices, we get exhaustion. The price reverses straight back to my entry price. So this is an incredibly important principle, although on the face of it, it seems very simple. It is the foundation of the vast majority of prop-based strategies, not commercial-based strategies as such, but it's certainly the basis of prop-based strategies. And it comes back to a very simple pattern, and it's this pattern here. What does this pattern remind you of, guys? Well, it's a little simple pattern that we've talked many times about. It's the favorite pattern. It's, of course, our double distribution lower, isn't it? It's that simple idea that we then see the process evolving as a double distribution lower. And a double distribution lower is a lower held offer, correct? Because how did you get a distribution at a lower price unless the offers were being held at a lower edge? So what does it mean if offers are being held at a lower edge? That means there's sellers at a lower price, because there's always going to be buyers at a lower price, isn't there? Do we agree with that? There's always buyers at lower prices. The market maker, for one, is a buyer at a lower price. Commercials are probably going to be buying at lower prices. Really bad retail traders are probably going to be buying at lower prices. So we know that there's always buyers at lower prices. It's basically seen from the supply-demand graph of any any industry at any time, there's always buyers at lower prices. There's always sellers at higher prices. So that doesn't tell us an awful lot. What tells us an awful lot is if the price then doesn't just simply go from a bid to an offer to a bid to an offer. If we go from a bid to a higher bid, well, that's exactly what we're looking for. It's a higher held bid. Now, what that tells me as a buyer at lower prices, as a commercial buyer at lower prices, is the sellers are willing to come down to my price. What does that tell me about my price, Tom? If the sellers are willing to come down to my price, what does it tell me about my price? Anyone, what does it tell me about my price? If the sellers are willing to come down to my price, what does it tell me about my buy price? I don't think it was that challenging a question, guys. My buy price is probably the wrong price, right? It's probably the wrong price. And I'm probably going to get a far better price if I just wait for 2 minutes. So what does that tell you about the bottom edge? It's a weak bottom edge because I think it's probably going to be a lower price than the price I'm willing to pay for it. So that means that the best trade is what at that stage? What is the best trade? If we see that happening, the best trade is to sell towards that weak price, isn't it? Now, the challenge you've got is by the time you see that, you've already got a retail price for your product. You've already got a retail sale price. And therefore, if we start looking at this as a balance here, the vast majority of the guys in the room would start selling in this price here, wouldn't they? Or the vast majority of guys in the retail space, I should say, is selling at that price. And therefore, there's an actual incentive, not at this stage, to go lower. There's usually an incentive at that stage to then trip out some stops into a reversal back out. And then we start looking for opportunities basically from the spring trade and above up to the prior balance to look for a rejection. And when we get up into that price area, we don't want to see it balancing because that means we're getting a double distribution higher. The buyers should not be willing to cross the spreads into that price, should they? Think about the conversation we just had. If I'm looking to buy into this bottom line here, if I'm looking at this area here and I'm suddenly seeing the sellers willing to come down to my price, then my next buy trade isn't going to be up here, is it? My next buy trade is going to be down here perhaps, but it's certainly not going to be up here. So if my next buy trade is up here, the story that you thought was true probably is not actually true, isn't it? And we have to start reading that on a candle by candle basis, on a trade by trade basis. So when we see this pattern forming, you'll see I've highlighted two of those patterns. Now, a lot of people say, but how do we start defining balance? And it's just your mind's eye, isn't it, at the end of the day? Did you see enough selling coming in at a lower price? Well, we can see that from a pivot. You could argue a pivot gives us that, overlapping candles. There is no definition. You might say, but we can do things like the little boxes. Everybody loves a little box on the trades, don't they? They put a little box on the charts and there it is, and there's nothing wrong with that. So you'll hear Paul mentioning his Darvis chappie. And just draw a bloody box, guys. It's not about whether an indicator can draw you a box that's relevant. You should be able to see whether it's relevant. Do you agree with that? And you might be open to discussion. It might be open to challenge if it's a baseline that you've got one swing high and one swing low, and you say, is that a box? Maybe it is and maybe it isn't. But remember, it's not just because of this that we're going to be selling it or buying it. It's a starting point for your discussions, just like everything else. Just because I see sell side value doesn't mean I'm immediately selling it. I'm trying to think what price I'm going to pay. And that's more about what this idea is all about, is trying to recognize what price I'm not willing to pay, and therefore starting to recognize the prices that I may be willing to pay based on the fact that I've seen evidence of lower held offers. And that gives me the idea that if sellers are willing to pay this price and I can then sell at a higher price, then that's a great trade for me, correct? It's got to be. So when I see this storyline forming here, does it look like this is visible to all of you? Now, you might argue that it's this box here or it's this box here. It actually doesn't make any difference. It doesn't matter if I draw, this as 2 boxes here. I could draw a box there to start with, which would probably have been perfectly valid. And then when it extends, you go, okay, well, it's basically just an extension. When it overlaps the box here, you say, well, that's the box. I'm not going to lose any sleep over whether that's the box or the lower box is the box. It doesn't make any real difference. The question I've got, actually, that makes the difference is there evidence of selling at lower prices, yes or no? That's all that I'm interested in. If there's evidence that there are sellers of lower prices, I am already actively watching this space here for sellable opportunities. That's all I'm interested in. Because if I know there's sellers in this box here, well, if I can get a better price than that box and the value hasn't changed for any particular reason, I'm going to make a very easy trade, aren't we? It's just your double distribution down, selling into the groove between the 2 distributions, that little low volume space, and then working the offers into that low volume area. The takeaway from that trade is, of course, stunning. And a lot of people will say, yeah, but where do we go from there? Well, we just keep doing the same process. And again, we can see that on a downtrend, we've got a double distribution down from here to here again. And again, it's at a lower price, which makes life a lot easier for us because it's still trading on that sell trend. And as it comes back out of that area, we can see that we're running some of that liquidity in terms of stops just in there. And it makes perfect sense that we start selling it again, knowing that there's a lot of sellers here. And if they puke, there's a very, very good chance if those sellers, buyers box in this area pukes, that we're going to be taking off the swing lows down into the day session lows here, aren't we? We're going to run this as effectively a sweep of the bottom edges. Taking on the low edge in this type of scenario is one of the highest probability trades known to trader kind. And then we just keep it going and we just keep asking the storyline over and over again. But we also are, we're alerted to the fact that the story changes literally on every single candle that paints from that point onwards, doesn't it? And this is, I suppose, what's exciting about the story. Now, obviously, we've got the Max Steelbook that starts to tell us when we've got lower held offers and higher held bids. The boxes, the red boxes and the blue boxes actually inform us of that in a very short term window, allowing us to make the highest probability trades at any point on the screens, at any point, actually using not boxes to find that, but actual bids and offers. Knowing that they've got a higher held bid or a lower held offer is incredibly valuable to us as traders. I know the dealers are going to offer higher prices, and I know the dealers are going to bid lower prices because that's their business plan. That's it. But bidding higher prices isn't their business plan. Bidding into a higher price area like this area here, where you see the blue box trades that ever so slightly higher, is not part of their business plan. So for a dealer to make that decision to bid across that line there is really, really valuable to me to see that happening. Going from the blue box there to the blue box there. And then, of course, the non-farm payrolls rips. The seller at higher prices is something, but it's obviously just normal to see the seller at higher prices. It's also quite valuable because I know that they're not yet selling at lower prices. So if I know they're not yet selling at lower prices, I can then start knowing that that's the case. I can start fitting it in with the rest of my ideas, and I can keep pressing if I want to, if the value tells me to. But when they start selling into lower prices from there to there, I know that there's a very good chance the price is going to go down to there. When they start buying at higher prices from there to there, I know there's a very good chance that they're going to pull the offers from there to there, and it's going to start moving through the sequence. Just seeing that allows me to make great trades in great locations. Simple, without having to see any boxes forming in any shape or forum. Now, this reminds us, of course, that this is part of what we would then term the market maker's interns exercise game. I mean, that's pretty much what it is, isn't it? If we think about the interns exercise simply from a line drawing point of view, we know that this idea here of the price then turning before it reaches the swing low means that there must have been a higher bid, correct? Must have been a higher bid. And therefore, if we can recognize that that is what a higher bid looks like, then all of a sudden we can literally start from nothing and just start finding the fact that there's a higher bid here, which means there's a very good chance that that seller there is going to pull. So therefore, when we see that, we say, well, there's a spring trade there. It doesn't take away any of that story, and we go bid away from that narrative. And sure enough, something happens. But everything that comes from this point onwards is now new information. The faster the price moves away from this area, the higher the probability is that we will get what? A new higher bid, that the market will stay bullish. Well, we can watch that as it develops, can't we? We can actually watch it as it evolves every candle. And what can sometimes happen, of course, is we get a price that then sticks around here, in which case we're still buying on dips. But sometimes what happens is we get a trade that does something like this, isn't it? Sometimes that's something that happens there, and what happens is we see this evolving story perhaps in this area here, and you start saying, well, wait a second now, that's now excess, correct? And how did we define that as excess? Because we're now getting lower held offers. And if I see that lower held offer and there's too many sellers in this area, it's quite obvious that the dealers will probably try and take the price maybe up through that area to some degree or another. And then there's going to be an opportunity for me to work into an offer into those prices, right? So the price may well run a little sweep to the previous stops, and then we get this beautiful sell coming in at that point, right, off of this rejection here. And you say, well, we're going to sell into this little space here, and we should be able to make some very, very easy trade to the downside. Trading from rejection to acceptance is always the way you should be trading, always. Rejection to acceptance. So when we see acceptance, acceptance for me is these blue boxes. If I see acceptance at higher prices, I know I should keep bidding into it. If I see the pink boxes rising, that's acceptance at higher prices as well. So the pink box at higher prices, there to there, is acceptance at higher prices. So I keep bidding into lower prices. When I see the blue line starting to flatten out a little bit, and I see the pink line still slightly higher than it was before, I still think we're good to go. I still think we've got an upside pop on this. And then the pink line goes higher. The blue line also goes higher. The pink goes higher. The blue goes higher. And I think we're still going to stay bid on this. And I'm going to keep bidding into these trades. So you can start recognizing the process. But, price action allows you to see the same thing through the interns exercise. As I mentioned, one of the biggest takeaways is the ability to define what excess looks like and feels like. It shouldn't be that difficult. I've got an awful lot of stuff on this chart, guys, so I'm going to have to just clear it out. Because even at really high prices here, you can see this same storyline of the offers at higher prices getting pulled, allowing me to start working hard on the buy side. And then we got this beautiful sweep, which ended up making over $1,000, to be fair. But every candle becomes a piece of information. So when I see a trade here, and then I see a trade here, what's the probability, just looking at that? I mean, it's not a difficult question, I don't suppose, but what's the probability that the trade has excess above versus below? Do you think it's got excess below, or do you think it's got excess above at this stage? Excess. It's got excess up here, hasn't it? How did you come to that decision, Miguel? It's dead obvious, right? Because if the price is rising very slowly, it must be getting some selling coming in, right? If the price goes up very slowly, there must be some sort of element of selling. So if there's some sort of element of selling, that's what we determine to be that's what we determine to be acceptance. And therefore, if we determine this to be acceptance based on this as a storyline, which direction should the price go in? Well, the price should now do that, shouldn't it? Should now do that. Doesn't always do that, but it should now do that. And what else would we be able to measure against this? What else would show us this as a storyline? Something else we know very, very well indeed. We've been touching on it a lot in the last couple of weeks. VAR, right? VAR, so volatility, absolutely. So if I was to look at VAR during this period, does everybody know what VAR would look like in terms of volatility? Sure. Well, you should do. So if I drew VAR going up like this on that drop phase, would VAR be the same speed coming down? See how VAR is basically doing that? It's just showing that very, very low volatility. Very low volatility, right? So you start recognizing that VAR shows me that storyline as well about areas. Obviously, it involves the look back period, of course, that you're defining it from. But it starts to show me these elements, doesn't it? The VAR or volatility is getting highlighted for me. And I can look at that and say, right, well, they're dropping vols on the way down and they're increasing vols on the way up. So I should have a very easy journey buying into this, shouldn't I? A drop in VAR is acceptance. A rise in VAR is rejection, or alternatively, an acceptance, an agreement, if you like, between the buyers and sellers that the price needs to go up or down. So we start using VAR to help us with this type of information. With fast and slow candles, we've just done that on the right-hand side here. The idea of fast and slow candles allows us to make that same judgment call. We also have another indicator that fills that void for us, doesn't it? It's called the max spectrometer. Because the max spectrometer is exactly that, isn't it? It's the idea that it finds acceptance at higher prices or lower prices, doesn't it? That's what it does. Because technically the spectrometer should be a way at the top and a way at the bottom. And if it's not, that's telling us that there is now an imbalance. It's telling us there is now a higher acceptance or a lower acceptance, isn't it? So if I look, for example, at this very, very trending move on bonds, can you see all those lower acceptances? Absolutely. I'll draw some boxes using max spectrometer. So we can all agree that this blue line and black line are a lot lower than this price here. Yeah, both of them are lower. And the price is higher. Well, that's a higher acceptance, isn't it? That's a higher held bid. So if it's a higher held bid, the next move is most likely to be in what direction? It's most likely to be higher. We can see that the blue line and the black line are also lower in this location at a higher price. And on that occasion there, because they're lower at a higher price, this price area here, which seems very extreme, is still suggesting that we're likely to still see higher prices. And sure enough, as if by magic, we then see higher prices. We see a little situation here where it's quite obvious that we've dropped off of this area here at higher prices. So you're still thinking to yourself, shit, this is still higher prices. And again, we see the next situation here where it's still higher prices. Now, the one thing you'll recognize as a trader is that eventually, because the spectrometer is diverging so significantly, that the spring back to the top side is going to start showing us a similar type idea. We'll start seeing that exhaustion print into the top edge. And if we start seeing it too often, you'll start seeing that the top edge becomes what we would then simply recognize as a normal value divergence. When the volume starts shifting aggressively, and you see the volume really shifts aggressively on that one, doesn't it? The volume is dropping out of this, suggesting that we may see an exhaustion top edge. You see that? See how the blue line's way below, actually really opposite the black line during this last couple of legs here, right? See it? So what that normally tells me is that when the blue line is starting to dominate this buy side, the reason why the market makers are on the buy side is because they're starting to see a lot of sellers coming in. Do you understand that? Do you understand that? So if the market maker's starting to see a lot of sellers coming in, they're still jamming them, of course. That's pretty obvious. They're still jamming them. But we now know that there is a high probability that if there's a lot of sellers coming in at these price areas here, which is highlighted by this blue-black relationship, there's a high probability if we can start seeing that selling being isolated by the spectrometer, there's a very good chance from that point that we may start seeing a top edge. Well, that's exactly what happens where? It's exactly what happens in this location here. Do you see it? Because that's what excess should look like right there. Interesting, isn't it? That's what max excess should look like in that location. Because the volume is pointing lower, but the price is pointing higher. Well, that is an excess situation at those higher prices. And it comes on the back of seeing it getting jammed up in an area like this. And you might argue, is that not excess? Not really, because the black line's lower. The black line needs to be going higher still to show that excess is now visible on the screens. So I now determine that this is excess up here. And I've now got a chance of working that excess against that spectrometer storyline. A similar situation, perhaps you could argue, happened a little bit before that. So if we go back over to this area here, you'll see a similar situation here. You'll notice that the blue line had been strongly above the top edges. See, the blue line is way at the top edge and it's getting jammed up in this area. So what does that mean? If the blue line is way above and it's still getting jammed, well, the market makers are seeing a lot of buying at the top edge and taking it on their books. So the market makers is seeing that, right? So the market makers has got to be seeing a lot of buying in this area. So what I'm now looking for is excess at the bottom edges, following that information. Can anybody see the excess candle? The excess candle's right there, isn't it? There's the excess starting to form in that area. Do you see it? It's a lower black line. Do you see how the black line needs to be lower? See how the black line needs to be lower? So you're getting that storyline actually showing up because of that, because the volume is still above, suggesting the buying is still here. So you're trying to trade into that excess based on the black line narrative, and you're saying, right, well, there's my black line narrative right there. That could be quite interesting at this point. And if you look at the comparison between that buy trade there and the sell trade there, they're very similar, would you agree? They have very similar characteristics of a story that's starting to show up. You'll see the black line starts to lead the market higher here. Do you see it? Sorry, the blue line starts to lead the market higher here. The black line, the blue line here starts to lead the market lower here. And we start recognizing that that's part of that story that we start to look for as a possible excess narrative. And obviously the bond excess up here turned into what was a brutal sell trade, obviously. And that's pretty good, right? That's a pretty good story. And what happened at the bottom edge here? We start seeing some buying coming in this space, don't we? So the market makers jam the buying in that space. The blue line is now divergent on the buy side. You see it? The blue line's now strongly divergent on the buy side. So when I see that blue line divergent on the buy side, what I'm now hoping for is I'm now hoping for an excess in here. And I'm not claiming that's brilliant, but do we see the black line dropping lower than the blue line here? It's, as I said, I'm not claiming it's brilliant, so don't think I'm claiming this is the same. It's not as good, and I'm not claiming it's as good, but it's a good starting point. And you can see that there is a possibility you could have read that as a bit of excess. Yes, of course, it would have been lovely if the black line was lower than it was before, but it's certainly lower than the blue line. And why is that important? Because if the blue line's starting to turn up, the buying is back in play. If the blue line's turning up, the buying is back in play. And in the meantime, it looks actually as if we've got excess selling opportunity here, isn't it? You know, because we've still got that small but noticeable divergence there, suggesting that the selling is still very much in play, and therefore this is very clearly what looks like an excess type situation evolving. And obviously the idea as well, how far could it potentially go? That's very obviously absorbing on this price area, isn't it? So you can see that the absorption, the idea of that trade is a high probability sell into that storyline. And we got an easy money drop back towards this, what looks like excess at the bottom edge. So we can see in this situation, they're still absorbing this volume. You see the market makers taking over the high price, suggesting now that there are a few buyers at high prices. So we're now looking at this and saying, right, we've got some evidence of buying again up into the top line. And now you see the black lines dropping quite freely away from that. And that suggests to me that there's maybe a little bit of excess to be formed in here. If the black line were to make a break below the bottom edge of that move there would be a very good chance that that would be a very clean buy trade. Very clean buy trade. So when we look at this as a storyline, we start to recognize that there are more than one way to recognize the balance, the movement of price. And when we look back at, for example, the oil trade that we talked about in an earlier segment, you can see just how good this trade really is, simply based on the price action on its own. We can already recognize that the speed of movement, we've already established that the speed of movement is really important to us because that leaves a value area behind, isolated, and that's useful. Because if you can leave a value area isolated behind, you leave behind a lot of trapped orders. And who's the guy that's trapped when the price breaks south? Is it the sellers or the buyers? Sellers or buyers? Who's trapped when the price breaks south? Well, of course, it's the buyers that are trapped. And if the buyers are trapped and you offer them an out, what are they going to do when you offer them an out? They're going to instantly sell their position out, right? So they lost a fortune here. You can give them their money back here if they want to trade it at that stage. So there's going to be a lot of sell orders in this area, isn't there? A lot of sell orders in this area. And you can take advantage with all that selling coming in and take your shot. You can see we then got a fast candle reversal coming through here. We got a lower held offer down here. And the same storyline is still true, isn't it? It's still very much a sell trade. You say, but where's the sell? We've no idea. Don't think there's an answer to that question, Laurie. There's no answer to that question. We don't know where the sell is, but what I do know is the sell should appear above that price. And I'm realistically trying to think that, well, I don't really want to see it up here because that's a bit stupid. You know, if you're going to sell it, the idea is you'd need a sell coming in. So the idea is that we should probably expect to see a sell realistically in that box there, shouldn't we? Realistically, that would be the best place to sell it. Just the same way as this box here at a lower held offer. You would draw the same line there, and I'd say if you want to sell that, it's quite tight to the top edge, but if you're going to see a sell in there, it's going to be somewhere in that box area there. Same trade, same setup, same structure every time. And that's exactly how this whole entire drop here has played out. Can we get more aggressive into these moves? Sure. What would cause us to be more aggressive? Trapped buyers would cause us to be more aggressive. Too many sellers coming in could be another reason why we might want to take the price up more passively. So it depends upon an order flow element. But obviously we also have a value element. If the value collapses, do you think, for example, with the value collapsing here, do you think we're going to get the top box in the retest? So when the value collapsed here, does that retest box there look realistic? No, so what are you going to do about it? You're going to adjust your ideas and say, well, I don't think we're going to get anywhere near that liquidity. And you start seeing a seller coming in, you're just going to join in, aren't you? You're going to say, well, that's the play. That's got to be the play. And you start adjusting how aggressive or how passive you're going to be based on what you then see developing, aren't you? You're not going to sit there waiting. And obviously at that stage, you'll also notice something else that was happening on the right-hand side of your screens here. You know, this is a 5-minute oil chart, and this is a 1-minute oil chart. So this retest here is that retest here, correct? You'll also notice there was a lot of sellers coming in. So on a 1-minute chart, you see that there's a lot of sellers here, right? That means that you're going to have to be patient about the top edges, aren't you? On a 1-minute chart, you're going to say, well, I'm going to have to sell above that price because there's too many sellers came in on their first retest. So there's an element of passive selling that you need to do based on the order flow part of the storyline, correct? Too many sellers, you can't join in. Too many sellers, you're going to be paying retail prices. So if you saw that sale coming in, you would have sold it exactly where that Voltic is right there, wouldn't you? That would have been your price. Well, that would also have been a panic trade, wouldn't it? Because you're now selling at a price you know with the amount of sellers coming in that is highly likely to be stopped out on the sweep higher by the market makers. So which part of this story is the most important? There is no one part that's more important than any other. Because if you got the sell right here, but you got the wrong price, you got stopped out anyway. If you hadn't seen the value improving significantly, you would never have been looking for the sell in the first place, probably. If you hadn't seen the lower held offers down in this space down here, you would never have been even contemplating it because you could have looked at that fast break away from there and you would have then said, well, that's a lower held offer, so I'm going to be looking basically back into this zone and it shouldn't go through the top edge. Because if the price accelerates too far up to the top edge and then the buyers hold here, this would be a top right hand held bid now, wouldn't it? So if it goes too far, it's probably telling you, don't even try selling it yet. Make sure you see the rejection before you play anything here. So every candle with every angle that we're going to be looking at is still part of the same story, isn't it? We don't just take it because of the lower held here. We take it because of the lower held plus the lower value plus the storyline from the order flow. We take it because it's now below VWAP and it's away from these VWAPs. We don't want to sell too close to those VWAPs there. Those VWAPs have been in play for some time, of course, but selling between the VWAPs means that we're in a squeeze territory area. And if we're in a squeeze territory area, what's your probability that the market's going to be sell side versus buy side? Probably quite high because we've came from above VWAP into the VWAP squeeze area here. And because it's now squeezing as a balance area, there's a very good chance that in this case, it's probably now going to squeeze sell side. With sell side value, it's almost definite that it's going to squeeze sell side. With sell side deltas coming in, it's almost definite it's going to squeeze sell side. Everybody loves a sell. It's just these sellers came in here way too aggressively and ended up paying the price by getting stopped out as you started to run the stops at the top edge up there, giving you the perfect entry price off the 67 evens, making yourself $400 on the drop phase within 5 or 10 minutes, which was a beautiful trade. So trading's more than just one thing. Well, we know that. Everybody's clever enough in this room to recognize that trading is going to be more than one thing. And the type of trade you take, of course, is also not defined by being in this room. We have people that like buying bottom edges and selling top edges. I'm one of them. But that's because we trade a commercial book. Whereas a lot of you guys are going to be more inclined to be buying top edges, as in pullbacks from top edges, and that's more prop trading. That's the way that the Algorithms, HFTs, are more likely to perform in terms of momentum algorithm. You can't have a momentum algorithm buying a low price because the momentum is sell side, of course. But it's not one aspect of this. It's about making sure we understand the aspects. Something else we mentioned was the ability to trade the right kind of contract sizes, and we highlighted this with the example from our bonds from yesterday. And and maybe a few people noted that was a wee bit unusually, maybe certainly caught a few people's attention when we did mention it yesterday, this morning as well. Hold on a second, I'll find it for you. So when you're looking at retail trading versus commercial trading, and we had this conversation with some of the interns about trade size selection, and we were trying to get them to understand the concept from a micro point of view. And obviously when people are learning, the idea is that we've now got a very successful bottom edge. Well, hindsight's a wonderful thing, but it was a very successful bottom edge. And what I said to them based on a micro account, let's assume that their maximum position size is 20 micros. When the price drops, you're buying singles. Singles, 1 out of 20 of your contracts. By the time the price reaches the very bottom edge, you should now be in 10 positions, maximum 10 positions. You say, I don't know why it would be a maximum of 10 if the maximum's 20. Because we don't know if we've got the bottom edge right. We don't know if we're anywhere near the bottom edge. When the price marks up, we can take some of those 10 contracts and we can close out maybe 5 of them on the push higher. When the price then pulls back, we're going to go all in, so long as it's not at a lower price. If it's at a lower price, we buy ones again. If it's at a higher price, and we think that we are now going to be trading a buy-side trend with buy-side momentum, we're basically going to go in with the full size at this point. It's now a momentum trade, which means we need to get some movement relatively quickly compared to the way down. And obviously from that point onwards, we're now all in, which means we've got full size. We can now afford to distribute as we move out of these trade areas. And we've ended up with an incredible buy trade, which for some of you were laughing right through the US session because all we seemed to be doing was buying lower prices. Turns out we were 100% right to be buying those lower prices. I mentioned earlier, this was one of our biggest winning trades on bonds this year, simply because we got such a good hold into the bottom edges to build into this. Now, some might say, I don't understand, it's lower held offers. Why were you buying it? Because we're commercial operators, not prop. The right trade in this area would have been to keep selling down into those holds at lower prices, wouldn't it? So that's perfectly validated by the idea that prop selling to commercial is way, sometimes it works. It's the way the trade works. So when we see this as an idea, when we see this as a concept, you can start seeing some other elements. Here's a good example of the bond again here. You can see that this is quite clearly what you would have imagined in the background. If you saw this 2-candle structure here, would you imagine that that is excess at that price, yes or no? If you just looked at the 2-candle structure there, would you say that that is excess? Yes, you would. Could this be excess? Yeah, it could be excess. But was it excess when you saw what happened next? No, it was acceptance, wasn't it? When you look at what happened next, we then look at that and say, well, that's acceptance in here. Yeah? And if that's now acceptance, and we recognize where it is, we can now look at that there, and we can obviously look at that very clearly and situate without any problem. That's got to be excess, right? Now, does that help me? Well, of course it does, because if I can now define these two areas of acceptance and excess, then what I can now do is I can now draw a line. I can say, well, if that was excess and that's acceptance, I can now draw a second line which I can now look at acceptance and say, well, I think that that's the structure of the market just now. Would you agree with that analysis? I'm not saying that I'm drawing this as an accurate projection of where price is going to go to, but what I'm saying is I am making a decision during this balance that I'm seeing this as a storyline. And some people say, but the price from the drop off the top edge is just as much as the price of the drop off or the rally off the bottom edge. No, it's not. What's the fastest candle? Is it a green candle or a red candle? It's a green candle. The prices came from here very quickly through here and not so quickly back to the bottom edge. Read the story, for God's sake. It's not that difficult. We know where acceptance is. We know where excess, therefore, resides. We therefore know what price excess was seen at. If I get an opportunity to trade excess in the future, would that not be a good trade, knowing that there's buyers above you? Is that, in fact, not exactly what we're doing as traders on every trade we're taking, knowing that there's buyers into 118s? Of course it is. Now, it doesn't tell me that I want to buy it if the price were to fall. The value might be collapsing and the excess might start to change. I might start finding an opportunity at lower prices to see an acceptance at lower prices, right? I might see an acceptance there, in which case I might change my mind. But I've got to get there first, Theo. I don't know what's going to happen next, right? I don't know if it's going to accept lower, reject lower, but that's where I'm at right now. And that's all we can ever do. So when I paint this picture, what happens next is pretty spectacular. You see the price trading down to excess. You see the opportunity then to take a shot at it. And sure enough, if I take a shot, I don't know if it's now going to get accepted lower, do I? Do you ever know if it's going to get accepted lower or higher? You're never going to know, so you're never going to know. So what's the point of worrying about it? It'll do what it's going to do, regardless of whether you're in a position or not. It's still going to do what it's going to do. And if it does do what it's going to do, then you know what you're going to do. You're going to get off the trade relatively quickly, aren't you? So you wait for the response. Was the response acceptable as an excess buyer? Does it look healthy? It absolutely does look healthy. You think the price is probably going to trade back to this acceptance high, don't you? Yes, and it does trade back to your acceptance high. And you get a great opportunity to say, right, I'm going to book some nice money. Thank you very much. This looks superb. Why are you a little bit concerned? In fact, why did you even take any profits off in the first place at 118s? Well, remember we talked about the speed of the candles? Well, take a look at the speed of this down candle. This is a lot faster than this up candle, isn't it? So when we then saw this down candle, does this look like we're getting a beautiful rally back towards the top edge here? Not really. Looks kind of rubbish, in fact. It looks like there's some sellers coming in. So when I start seeing the price trading back towards the top edge, would it be reasonable to start being a little bit worried and making sure we book some of our money? Absolutely. Absolutely. Is it still rejection at the bottom edge or not? Could we still define this as rejection at the low price? Did it seem to accept down here? It definitely didn't accept, right? It definitely didn't accept down here. And therefore, we can still keep the same game plan at the moment. We can still think about the probability that there's a higher move to the upside coming. And from that, were we right about that story? Well, kind of partially right, weren't we? Because we saw a beautiful push to the top side, but this rejection of the top edge is genuinely quite worrying, isn't it? If I was to draw a reg line through the average best fit price, would it look something like that then? The best fit price. So that's a little bit concerning, correct? That's a little bit concerning. If you see a reg line that's looking a little bit like that, you're saying, oh, wait a second. In the short term, I'm certainly not going to start bidding some 28s, correct? In the short term, I'm certainly not going to bid some 27s, 26s, even 25s I'm not going to bid into. So as a buyer, I'm thinking to myself, well, looking at what we've seen, it is still a higher acceptance. Nobody's denying that that's the case, but there is a problem on this right now. And I think perhaps we might need to see a price of about 21 before I'm going to bid for it again. Would you agree with that? So what are we doing in this example? We're simply getting ahead of the price action, aren't we? We're looking at the response on a candle by candle basis. We're looking at how it's evolving on a candle by candle basis. We're looking at fast and slow on a candle by candle basis. And we're starting to come up with some ideas, pricing the markets properly. Looking at what we hope to see versus what we do see. What we need to see versus what actually happens. Is it close to what we want? Is it better than what we want? Is it a hell of a lot worse than what we expected? And because of that, we make good decisions. We stop making stupid decisions like buying at 26, for example. That's not going to be a very healthy decision going forward, is it? So every trade, and I think this is where most retail traders fall down, is that every trade, you should be doing this amount of work. You should be reading it as it goes. Now, interestingly enough, we painted a scenario, two scenarios for you from earlier. We painted two scenarios. We painted a bearish scenario and a bullish scenario. So let's actually go into that NASDAQ at the time and see what we would have been thinking as these two scenarios potentially played out. So we all agree that these were all on the charts on the right-hand side, these two scenarios. Now, I know hindsight's a wonderful thing, but let's be honest about what we were seeing during these periods. First and foremost, is the bias of the market bullish or bearish? The bigger bias, is it bullish or bearish? It's bullish. It's incredibly bullish, right? So would we be preferring to see, more inclined to be looking for evidence of buying at higher prices? Because we should see a lot of selling in there, shouldn't we? We should see a lot of selling, and it's not going to be that important if we do see selling. What's going to be really important is if we see buyers at higher prices. Pretty simple stuff, right? So now that you've seen where the trades are, what I'll do is I'll get rid of the drawings so that we can actually go behind them, right? So you just take an image of what we were thinking at the time, and let's just look into this little balance area so that we can analyze it on a more individual basis. So let's get rid of all these drawings, and we'll now come into this area and think about what we actually saw through here, okay? Because this is a classic, isn't it? It's a classic P shape. The whole thing is a classic P shape. So if I'm coming up from a bottom edge, it's quite obvious we're going to get a higher held bid, isn't it? I mean, the previous balance is below the bottom of the chart, right? So there's almost 0% chance, almost 0% chance, Tom, listen to that number, that the market will not accept up here. Almost 0% chance that the market will not accept up here. Is that not impressive numbers? Damn right it's impressive numbers, right? Almost 0% chance. Does everybody agree with those numbers? I mean, you'd have had to have had a hell of a V bounce. In this case, a hell of a V drop for the price to accept below the prior acceptance, right? So in this rally, the price would have had to have realistically have dropped from the top edge without balancing, probably realistically down to there before we could then say, oh, well, it's a lower acceptance. Would you agree with that? What's the chances of that happening? Out of 100. What's the chance of that dropping to that price out of 100 on the next few candles? Pretty close to zero, right? Pretty close to zero. Would you agree with that? You could do this on any candle, can't you? So for example, on these series of candles here, if I said to you, what's the probability we're going to go from this candle below that balance at that point there? What's the probability? It's pretty close to 0. Listen to what we're saying. It's pretty close to 0. So what's your preferred trade? To be a buyer once you see the higher held bid. To be a buyer once you see the higher held bid, because you don't know if it is going to be there or not. You just have a very strong sense that it's going to be a higher held bid and you're going to be looking to be buying into that phase. So we've already came across this area here where we look at this and say, right, it's almost 100% certain that it's not going to do that. We've already, well, some of us have agreed that it's almost 100% certain that we're good to go on the buy trade. Things can change. So what we did in bonds, can we do on this chart, yes or no? Okay, so let's do it. If I draw a line here, is that line excess? Or acceptance? It's excess, isn't it? There's no acceptance down here, is there? When I start seeing this area here, is that acceptance? Are buyers accepting a higher price here? So this is acceptance, right? So if that's the case, have you now got your trade strategy already lined up for you? Have you got a trade strategy already lined up at this stage? Yes, you have. I've got a plan of action. I've got a few ideas. I'm going to be looking at this and saying to myself, okay, I know where excess is. I've got a pretty strong clue that if I was to, for example, start working perhaps around this area here, and I'm just straddling the excess because I don't know if it's going to be an aggressive buy or a passive buy, but I know it's going to be a buy because we don't know what the order flow is on this chart, of course. So I don't know how aggressive I've got to be and I don't know how passive I've got to be. I need to refer to my order flow to figure that one out. But I do know it's a buy trade, Tom, right? All of a sudden, well, what are you doing? You're certainly not selling it. If I said to you, where would you be putting an offer in right now? What price would you give me? Great question, right? What price would you give me roughly if I said to you, put in an offer for this? What price would you give me for an offer? Yeah, give me a price, Miguel. Stop being lazy. I would give you a price of 80. Why would I give you a price of about 80? Because because I'm cheap, right? No, because the bottom edge is 40. The middle price is approximately 23.60. So if the middle price is about 23.60 and excess is 23.40, a normal standard distribution would price the top edge at 23.80, wouldn't it? Yeah. So you'd be able to look at that and say, well, realistically, it's not quite 60, but it's just for the easy, simple arithmetic, right? But realistically, that's what it is there. And you can see it's actually 76. Okay, so boo fecking who. So we know it's actually 76. So that's the price I would offer you just now for that, for a sell trade. Would that be a reasonable sell? Why would that be a reasonable sell price? Because I know where there's sellers coming in at lower prices, right? Do you agree with that? Do we know there's sellers in this area? And lots of them? Yes or no? Do we know there's sellers and lots of them here? Yes, we do. That doesn't mean I'm a seller. So if I'm going to sell, I know there's a lot of sellers below me at 56, 60s area, right? So if I'm going to sell to those sellers, I've got to make a profit, Miguel. I'm not in it for the good of my health. So for me to make a profit in that, I've got to sell 76s. Right? And that simply means the same for the buyers as well on the other side of the book. So when I'm looking at this, I'm saying to myself, we love this as a buy trade, first of all, and most importantly, this trade is quite clearly rallied from a bottom edge to balance, giving us a very aggressive P shape from a profile point of view. Yeah? I've now got a couple of trade levels to work with at the present moment. And as I said, I don't know if it's going to trade above excess or below excess, because that's not a price action aspect. That's an order flow aspect at that point, right? If there's an awful lot of sellers coming in, it's going to be above excess. If there's a lot of buyers coming in, we're looking to get it below excess. Do you understand that? It's the rule of delta. So when we understand what the rule of delta is, we know where the price is going to be transacted at. And then when we start watching this area and we see how the price plays, right? We see how it plays out. We see it's a grind to the bottom edge. And it really is a grind to the bottom edge. And we start playing into this excess price point. And we start looking for evidence of an opportunity to play this. Now, you could already start. You might say, okay, but, and I know where we're going, you know, in the very short term, could we not have argued that there was an acceptance in this area here at lower prices? And I would say, yes, you could argue that that's the case, absolutely. Does it take away our trade? In the short term, no, it doesn't. The trade's still sitting there waiting for us to get the price. It certainly means that we could be more inclined to be passive. We see the same thing again here, and you say, well, let's just let it go, guys. Let it do its thing. It's still accepting at lower prices. Let it get to our excess level. Let it get there. Because this is acceptance here, isn't it? And this is acceptance here. So let it get to excess. We could probably even argue, judging by the speed of the move to the downside, that this is absolutely now forming an excess at top edge at this point, isn't it? Now, if it breaks the structure here and then balances, I'm going to start calling that excess. Because it needs to break structure and balance. Otherwise, it's just a top distribution, correct? Well, we haven't broken structure. If you haven't broken structure, it's still the same distribution at the top edge. It's got micro distributions inside of it. And is this not the interns exercise when you've got highs and lows? Of course it is. So when we trade into the bottom edge here, this is excess, and this is the top distribution. There are micro distributions, and therefore if I buy this excess, what do I need to absolutely clear on the first few candles? I absolutely need to clear this balance area here, don't I? On the first few candles. Because if it accepts at the bottom edge here, this is breaking. And I'm going to be starting to consider possible sells into even these types of price areas here, if that's the case. Because we could argue if this accepts low, if this accepted lower here, that is also an excess price because it had a fast break and it never accepted at all. It's got an imbalance. And therefore we would be able to then look at that holding below this price and then say, right, let's start working sell side 60s. But it didn't do that, did it? It didn't do that. What actually happened was we came off the bottom edge. We watched the first candle going strongly bid and we thought, quite sexy. Second candle's good. Third candle's brilliant. Now, of course, we could then hit this price and we could have got a single red candle here, in which case we're in real deep trouble, but stops are at break even anyway. We can get away from that real deep trouble without any real trouble at all. And then we start seeing a lot of pin buyers here. Is this a really strong sign? A really strong sign, right? We should be able to at least test the prior swing high, because this is the first time we've seen a higher held bid now, isn't it? From that excess price, a higher held bid here means that in the very short term world, just like we did here with excess and acceptance, If this is excess now, and this is acceptance now, and I put the price in the middle of that acceptance, I now know that I'm going to, as a minimum, trade 62. As a minimum, I should now trade 62. And I start thinking about that as a possible process. It might be excess. It might not accept at higher prices. It might reject that 62 immediately, trade back into this area here, in which case there's a very high chance we're going to run the sweep to the 30s. Very high chance. Do you see how far ahead of the game we're getting here, Theo? You see that, Rob? Ulrich, we're getting in front of the game now. We're starting to think about what might happen so that we're prepared whichever development takes place. We don't know how it's going to play out, but whichever development takes place. And as you can see, when the price action takes place, we get exactly what we thought we were going to get. Didn't we? Look, exactly what we thought we were going to get. The higher held bid in here opened the door to a very high probability trade at 62. It comes up to 62 pretty rapid-like, but there was a very, very fast response. Now, I thought there would be a fast response because that looks like excess up here. See that? It looks like excess, and therefore, in the very short term, there would be some people looking at that as an excess price, and they're going to say, well, I'm selling that. But if you sold it, think about what your next problem was. Let's assume you sold it, okay? So let's not just be always on the right side of this trade, because it could have been a situation that you thought, I want to be a seller here. If you sold it, what do you now need to accomplish? Exactly the same. So we talked about this buy trade needing to take out this balance, correct? Well, if this sell trade needs to take out balance, where would we need to get to on the sell? The sell would need to get through that area there and hold just in this space here, wouldn't it? But that isn't what happened. As the price traded down into the balance area, we actually started to see the buyers coming in again at that higher held bid space. Exactly, almost exactly, at the same price where we saw the buyers showing up before, isn't it? Almost exactly the same price. So if you were a seller here, I would now see that happening on this green candle, and I would now close off my short positions, possibly all of them, or possibly some of them, and I might well have got a stop at break even on the, well, definitely got my stop at break even at that stage, because it's not done what I needed it to do to be successful on this sweep. Doesn't mean I can't try again at higher prices. And obviously what happens next, of course, is that the price then does exactly what it should do. Look. So from this trade narrative here, we then get a very fast expansion through to the top edge. Does it accept the top edge, yes or no? Yes, it does. So when it accepts the top edge, the lowest buyer that we see showing up is there. So this could be a buy price for us. Yeah, because anything below that price would take us into a double distribution higher, into that price. And as we see the acceptance evolving into this area, and it's quite a strong acceptance, it's not a distance away from the high, it's actually right up into the high price. We can agree that there are more buyers coming in across this line here, isn't there? There's a lot of buyers coming across that line. So when you see the buyers showing up here and here and here, can I start thinking about buying here? Absolutely. Because I've got buyers above me. If I've got buyers above me and I still like the value in this, there's no reason why I can't take a chance at this. It's a higher held bid after all, and we've already seen higher held bids above me. So this is what we call a spring trade, isn't this all it is? It's a spring trade at higher prices. You've got buyers here on that candle, you've got a buyer in this candle, you've got a buyer on this candle. So if we run the sweep to that level, we're getting a spring trade against those buyers. We've got an acceptance here. If that's not an acceptance, what's my minimum target for this buy trade? Well, that should be relatively easy to do as well now, shouldn't it? If this is acceptance and I just put the price in the middle of that acceptance, and this is now excess potentially, I've now got a very, very minimal target, but I still have a new target price at this stage of 75. It's still a $400 trade, right? At this point, it's still a $400 trade. And on a macro chart basis, of course, one might say, well, you've got really this beautiful box area here that you can start considering as a high probability break, and we're now looking at realistically possibly even a test of 23,100. Could be within reach at this stage, couldn't it, on this higher hold? And that becomes a possible realistic target now as well, doesn't it? And what happens next? Well, you can see what happens next. We get a hold at the higher price area again in this area here. We get a rejection or excess at this price, agreed? So that we've got acceptance here. It comes through that acceptance. It comes into a trade spring area, which we would know is possibly a trade because we got a lot of buyers in this area, and that led to that spike higher. And on the face of it, it looks like this is definitely acceptance on the face of it, right? Sorry, this is definitely excess up here, right? But when it balances, when the price drops down here and then rejects and it balances here, it's still a higher balance, isn't it? So when the acceptance comes in at these prices here, and it's at a higher acceptance, the idea that therefore is excess is busted. And I now think we're going to be trading the 23,100 level without any real trouble. You don't know that until it happens. But my God, we're certainly having a good crack at it. And then you see what happened next. Obviously, we got exactly what we thought we were going to get, a higher held bid in here again, a higher held bid. And you're looking at that saying, okay, well, let's keep the process going. And when the price then breaks below that, you're looking to see where the next level of excess was at the time. And the last excess we could probably argue was here, wasn't it? That was the last excess. And then we're starting to see that as a possible starting point. Some might argue that there was an argument to put excess at that trade level there for obvious reasons, because we got a down candle into an imbalance, which suggests that there was a balance area here turning into excess. So that might have been a thing as well. But the one thing we do know for sure is that there was buyers at higher prices here. They are visible. We got a pin in that candle, 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 and they did push the price back up again. So there are buyers above me, suggesting that as we drop through this area, there is a fair case to say, well, let's try and buy away from this price. And whether you decided to be a little bit more passive and then you're looking for this as a buy trade here or whatever, at least you would have been looking at the right things. Now, what happened to that buy trade? Okay, let's go back to what we did over here. What did we need to accomplish when we bought this excess here? We needed to break the balance area beforehand, right? So if I'm going to buy this area here, what do I absolutely need to accomplish? I need to, first of all, establish where the balance area is that I'm trying to break. So if I drew the balance area as these two candles here, for example, did we break that balance and accept above it? Or did we break that balance and accept below it? Well, we broke the balance, but then we accepted below it, right? You see that the acceptance was actually down here, because that's where the buyers showed up. Are those buyers above that level or below that level? They're below the level, right? Those buyers are below the level. In other words, have we accepted above that price? Yes or no? It's a simple question. No, we haven't. What's above that price? A pin. So we're starting to get a little bit worried about this move. I'm now looking at this and saying, right, we've got definitely a higher acceptance, and this is excess. We can agree that that is 100% true, yeah? But the acceptance is lower. So my concern now is that if this is acceptance and it's a genuine acceptance at this price, then there's a very real chance that there's going to be a rejection of this price area here again, isn't there? And that seems to be a reasonable price area because of what happened over here. Because the sellers that came in the last time here, they're still, these guys here are still seeing a lower acceptance, aren't they? At that point, these guys here are still seeing that lower acceptance there. So these guys are still in play. These guys are still looking at this and saying, this could still be a sell, guys. This could still work for us. Don't worry about it. So always make sure you look at it from the other trader's side at this point. So when the price trades up a little bit, it seems as if the buyers are now starting to show up at a little bit more elevated. This is what we wanted to see the first time, isn't it? This is exactly what we wanted to see the first time. So now as a trader, I'm thinking as a seller, you know what? Yeah, let's just move away from the top edge for the time being here. Reasonable? So you're going to be pulling away from this area here and saying, right, let's just give ourselves a bit of breathing space at this 94 area. And obviously what happened was that the sellers just came in, took the trade. Okay, so the sellers came in and took the trade. You didn't know that before it happened, right? So when the sellers came in at lower prices and then took the market sell side, do you think the next acceptance will be higher and lower on that candle? Bearing in mind that for it to be higher, if this is now the balance area here, the next candle or the next two candles would need to go from here, go above here, not to here, but go above here and then accept to this price. Do you think that probability is high? Is this red scenario a high probability scenario or a very low probability scenario? Look at what you're doing, Oleg. You've just told me that the bounce on that is a very low probability scenario. So what are you getting ready to do? Trade it short, right? You're getting ready to look at that and say, okay, so if we're going to see balance as a double distribution, it now has to start balancing out below that type of price area. Because if that's the higher distribution there, then it's going to be a double distribution down here, correct? So you're going to start watching the price coming up into this area. Is your scenario painting to be true here at this point? Look at the size of the candles. What else are you noticing? Look at this. Look at the volume collapsing. You see the volume collapsing on the green buy candles? Does that tell you that there's massive numbers of buyers pouring in at higher prices? No, it tells us that there's no buyers pouring in at any bloody price. So the sellers are just going to take that and say, right, well, let's work it then. Let's work it. It should be relatively easy for me now to take this bottom line price out. And whatever happens at the bottom line, we're just going to have to deal with. Maybe they're going to buy the bottom line because that was excess before, correct? But if the bottom line breaks and we see an acceptance down here, well, we're going to go down to the price down here now, aren't we? So what happens? We see the price coming down into this excess price. We know it is excess. So what we're going to do, we're going to maybe take a little bit of money. We're going to say thank you very much. Now, the question is, do we build a lower balance? Well, what price do we need to build at a lower balance point? Well, we need to balance below this area, don't we? Realistically, we need to balance below that area, don't we? We sure do. We need to balance below that area, and we definitely do balance below this area, right? Because we see sellers coming in here, and we see sellers coming in there. So obviously, if you're a buyer and you want to buy this, you know that you've got to buy below that line, right? It's got to be below that price if you're going to buy it. But what's your problem? You know, you haven't got any higher price buyers, correct? There's no higher price buyers at this stage. There's lower price sellers, but there aren't any higher price buyers. So what are you definitely not going to do? What you're definitely not going to do is you're not going to pay that price for a buy trade, are you? Ever. Under any circumstance. Are you going to pay that price? If you're bullish, absolutely bid for this price here. Absolutely bid for that if you want to. But you're never going to buy this price. You're never going to buy that price. You're never going to buy this price. You're never going to buy this price, are you? That's suicide. If you were buying it, are you delighted with the outcome so far? Well, I'm fairly happy with the outcome. What made you a little bit more confident about the buy trade? Well, what made you more confident about the buy trade was the fact that the two sell candles had even lower volumes again. You would have imagined that if the sellers were now very excited about this sell trade, you'd have imagined that they would have sold hard on this candle, for example, wouldn't they? Did it look like they sold hard on that candle? It looks as if they've decided that their game's up as well, doesn't it? The sellers look as if they've says, wait a second, we've got the low price and that's enough for us at the moment. Do you see how it's not about just the price action? It's about reading the volume on a candle by candle basis. It's about recognizing the storylines that are forming in these areas. It's about recognizing the reaction that we see on a regular basis. Okay, so we missed the top edge. We missed the sellers coming in aggressively, and that's perhaps what the surprise was the seller coming in aggressively here. You say, okay, well, I get that. That leaves me with a bit of a challenge because, you know, the seller is still above us. We don't know if there's any sellers below this price area. We don't know that. So we're taking a gamble by selling in here because we're selling at a lower price and we haven't established that there is any sellers below me here. So this is always going to be something. So if we then swept into this, we could establish that there's sellers below us, yeah? So if I was looking at selling this, this would have been the candle that I would have been excited about, right? If I was looking to sell it. Why would that be the candle I was excited about? Because we can see the sellers here. We can see the sellers here, right? If I sell here, can I see sellers in here? Yes or no? I can't see any sellers. So I'm gambling that there's sellers there. I'm gambling. And that's, I suppose, one of the reasons why you need to see these small green candles, because at least there's some evidence of selling on the way up. Because a green candle with a pin on it must have some sellers, right? Must have. But it's still a little bit limited because they're selling at higher prices. So they might just be a market maker taking a sell trade, right? That's not really that bearish for me. But when I see these sellers in here at lower prices, the sweep now is the better trade for me, isn't it? This is now the better trade. What makes it a better trade? Well, where's balance? Can we all agree that the prior balance was here? And because we started to see, for argument's sake, the selling coming in here, could we argue that the next balance acceptance area is here? Yes or no? So can we also therefore agree that between the two balance areas, the price is dropping? Can we therefore also agree that if I can get above any sell pivot, I've got sellers below me? Any sell pivot, sellers below me. Did I get above a sell pivot? Right there. So we know that there's sellers below me. Did the drop off in the buy side volume help me significantly? Are we a little bit worried about the selling below the bottom edge here? Sure. Are we going to start selling at 79? Not a chance. Are we going to start selling at 87? Sure. So again, we're getting a better, more accurate narrative about the fact that we have the right transition of price levels. We've got the right movement of sellers at lower prices. We've got the perfect short term, and with this very toxic sell coming in here, we think the buyers are on the pool, right? And we were right about that, weren't we, in hindsight? Well, it wasn't hindsight. We called that before this drop happened. So we were right about the buyers being on the pool because we could see the buyers on the pool. This was a live commentary, guys. So when we know the buyers are on the pool, there's a very good chance the buyers will stay on the pool. So selling into that press seems to make sense. Now we do have an excess level and a strong excess level here, because if we look at it from a balance area perspective, and this is balance for that excess, yeah? So there was a balance area here for that excess coming in again. And then we've got this higher balance. Are we in a strong position for this to go sell side? No. So this is a great exit price. If the sell drove through that area there, are we in a great position to be a seller? Absolutely. Did it do that? No, it didn't. So what are you going to do? As soon as you tap this level, you take your monies and you say, wait a second, let's see what happens. Let's see what happens, because we've got a big challenge in front of us here. A lot of challenging ideas to try and take into play here. And if we start looking at this from a technical point of view, there's a couple of things that could happen at this point, isn't there? So with a big balance area here and then this very strong bullish pop, there is a chance that we might see this price then rallying very quickly above this prior balance and then holding in here, in which case we're going to be looking at that hold at this price and say, right, we're going to start buying into this area. Somewhere about there, right? That's your classic higher head and shoulders for a bullish trade. What also might happen is we might see the price coming up into this area here. We might see some selling coming in and it goes up and some selling comes in, and that's giving us a lower hold. And we can take another shot at this guy, can't we? And if we get a lower hold, we would imagine that from swing high to this lower hold. So for example, if I now go into this lower hold here as a balance area middle here, and there's my swing high there, then that would give me a target price of this target price area there, right? And that's going to probably be enough to clear all the inventory from this area, isn't it? So what we would then expect to see is we'd expect to see the price trading here. And because that clears all that inventory, then what we would then expect to see is we'd expect to see the price starting to balance up down in this area here now, wouldn't we? And if it balances there, the sell trend is continued. If it balances in that area, the bigger macro sell trend is now on its way in a continuation pattern, and we're going to stay short playing into this as a narrative. We just keep selling those little excess breaks of structure to the top side, just like we did there, selling the excess breaks of structure. Trying to make sure we're getting that distribution at lower prices, and then putting the pressure on the buyers, the weak buyers that are in these locations here, hoping to take the market bid at a real good discount price. And they're going to be right eventually, but it's going to take a lot of tries before that happens. At the moment, this is excess, this is excess, and this is excess. This is acceptance, this is acceptance. We are in a sell-side marketplace just now until that changes. And it hasn't changed yet, so we stay short. We stay with that play. We stay looking focused, ready to play this. Can you see how important this process is? I mean, this commentary here was all right-hand side. Most of what we've talked about here has been since the classroom began in this area here, and we've been kind of commentating on this pulled bid and all that kind of stuff. And it's played out exactly as we thought it would be. And that's without any value, that's without order flow, that's without anything else except to recognize the way that the auction is unfolding. The lower holds, the basic ideas of what lower holds should be and what they are, and then recognizing that we're not forecasting a future here, we're forecasting what? Possible futures, possible scenarios. Everything we're forecasting here is a series of probable scenarios, possible scenarios that eventually evolve into probability distributions. When it first starts out, we started to draw possible scenarios. The possible scenario is it breaks to the bottom edge here. The possible scenario is it then does that. And then we start saying, well, if it does that, there's a high probability that it's going to balance at a higher price, which might be up here. And we start saying, right, that's a possible scenario. But after the first and the second and the third candles, is that possible scenario becoming probable or less probable? It's becoming less probable at this stage, isn't it? So we start recognizing that the probability of that possible scenario is getting less, and we start looking at that and saying, well, let's take it off the table then. Let's bust it, right? Let's make that one irrelevant for the time being, and let's focus on the probable scenarios with this price holding in this area. Let's try and work into that as a seller, and let's see if we can get a little bit of a movement here. Because this probable scenario seems more realistic at this stage. Can it change on the next candle? Sure. Can it change in the next 10 minutes? Sure. It can change any time. The point is that we're traders. The point is that we will adjust if it does change. The point is that we will change our plan if it changes. We don't know if it's going to change. We're not fortune tellers, guys. We're probability traders. We don't predict the future. We trade the probabilities of the present. And that should be good enough to be successful. That's all we ever do. We don't claim to be able to predict the future. We simply just trade what is likely versus what is unlikely. And we make sure we get a good price for the probability that we have. And if you did sell it, and there's no reason why you wouldn't sell it, are you getting a little bit worried? Are you getting a little bit worried? Sure. Why are you getting worried? Where the hell is my sell side momentum coming from? Where the hell is my sell side volume coming from? I'm getting a little bit worried, right? So if you're getting a little bit worried, would it make sense to just be a little bit more pessimistic about taking a big profit swing from this and just book a little bit of money and get a stop in at your break even? Of course it would be. You trade as you see it. You don't know what's going to happen. You trade what then does happen according to the possible, probable scenarios. So when I see these crappy little shite candles there, I'm starting to say, wait a second, I'm going to pull back my narrative a little bit here. I'm going to pull back my narrative a little bit into a balance here, because I don't think that this is the move. I don't think we're on the right trade anymore. Well, even in hindsight now, 2 candles later after saying that, we were right, weren't we? We were absolutely right. Did you all have the same opinion? Theo did. You saw the rubbish coming in behind you and you thought, that's not appealing. That really doesn't fill me with massive amounts of confidence that we're absolutely nailed on certain. Are we still getting a lower held balance? Sure. Are you bullish? Absolutely not a chance. I'm not bullish, are we? If we go higher, so in other words, if we clear this balance here and we go higher, in other words, let's paint a brand new scenario. Is there a possibility that that might happen? And then we get a higher held bid up here. Is that a possible scenario? Sure. Is the probability of that scenario building? Yes, it is. When did that scenario start to build? When we saw these 2 crappy red candles, when we saw that massive drop in volumes. So when we saw that scenario starting to build, why would you not take a bit of your money off the bloody table? Because you're stupid? You're lazy? No. So you would take money off the table, wouldn't you? You'd read the charts, you'd read the order flow and say, I think there's a probable scenario that could form from this. Turns out we were right, weren't we? You'd have just thrown away for no reason $100 for no reason by not taking your money off the table there, wouldn't you? You'd have thrown away $100, wouldn't you? You see how crazy good that is? This was all live on the right-hand side. You all heard it. You can look back at the recording if you were so bored that you had to go back to the recording and look at it again. But we told you that this is now a probable scenario. And we knew that not because we'd originally forecast it. We knew that because we started to see this small candle response to what should have been a momentum response on the sell side. We never got a momentum response on the sell side. So it became quite probable that we were going to get a momentum response on the buy side, because there's always a asymmetrical structure to the book. And if there's going to be a momentum candle to the buy side, what the hell would you be short for? It doesn't mean I'm pouring into buy trades. We certainly never shouted that we were buying anytime soon, that's clear. But that's okay, because we never lost any money on a trade that we could easily have lost money on, couldn't we? We actually made money on that trade, even though it was a failed auction, just by reading the two red candles. It is the holidays. The Americans are all starting to get a little bit edgy. They've probably all started to fire up their lunchtime barbecues. Bennett's probably pacing, waiting for Kim to get out the room so that she can go and start putting the burgers on the barbie. And so we better finish soon, because we don't want to get on the wrong side of Bennett. That's going to be a real bad outcome for all of us, guys. So have a great 4th of July celebration, Kim. Pass on all our wishes to Bennett, and also to everybody in America. Have a great holiday period. We'll see you guys on Monday. In the meantime, if you're going to join us, by the way, for the London session, I'm going to be in London myself anyway. So we'll be doing a normal trading day in London. So I'll just probably switch the charts on in London, but we won't be here in the afternoon. So don't bother turning up. All right, guys, have a good one. I'll see you guys then. In the meantime, adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsins, tak do svidania, and spasibo. Happy 4th of July, guys. Ciao for now.